Well, hello, hello. Hey, guys.
Hey.
And hello to everyone who has joined us. We're back with our weekly Fireside Chat and Steady State. Thanks you all for joining us today. I'm Crypto Empress, and I'm here to help to delegate the Fireside Chat and to help get your questions answered. Feel free to write your questions in the stream chat, and I'll forward them to our speakers. We also want to thank everyone who participated in Steady State's meme contest and sent us their fun memes. Great job, guys. Also, make sure you check out Steady State's ambassador program and sorry, Steady State's ambassador program, and you can find all the information from our Telegram and Discord channels. Today, we take into discussion DeFi insurance and see what's out there with our speakers, Jonathan, Akash, and Brian from Steady State. Please keep in mind that we are not financial advisors and nothing we say should be taken as such. This is for entertainment purposes only. So, guys, let's start with talking about who are major players in DeFi insurance space. Who are they? Can you please give us some insight?
Yeah, I'm happy to give you an overview, Sylvia. Sorry if there's a bit of an echo. I've been renovating my workspace here, so currently my desk is a ladder, but this is it's going to be nice when we're done. But yeah, sorry. Just to continue anyway. When we're talking about the insurance space, it can be kind of broadly broken down into two or three different types of roles. You have like the mutuals, like Nexus Mutual, which is member insurance. Basically, for members by the members, you buy into the mutual, and essentially then you're covering each other. So this would go on this old like shipping model where essentially trade ships would go away for months and they would essentially try to, if one ship out of 100 didn't come back, the community would reimburse them. So this would be like one of the first insurance models that came on the market. Nexus Mutual would sort of follow that. The clue is in the name. And then like following on from there, we have quite a few well, if we consider this, they're all like B2C. So essentially they're insuring individual actors. And following on from there, we have other ones like, let's say, Insure DeFi, which is a bit of an advancement on the Nexus model in that they are kind of introducing some more capital efficiency and some more kind of staking incentives and different sort of model how they provide insurance. So whereas Nexus, the mutual, you're buying into the mutual, the companies like Insure, they're doing more like what would be a product-based insurance. So you would buy some amount of tokens, and then you would essentially get coverage for a certain time for a certain portfolio amount. Yeah, then we have like some advanced players like Barnbridge maybe would be there. They're more like a risk. There's a couple of similar platforms, but they're more like a marketplace for risk. So I could say I think that Bitcoin will go down, and someone else will say Bitcoin might go up, and essentially I can hedge my risk by finding the other guy who will essentially take my downside risk or what I think would be the opposite play. So these kind of like work like a swap.
Just to add on that, Brian. So Barnbridge is actually really interesting. Them and Saffron Finance do something similar. What they are essentially are structured risk platforms, and they're important to have in DeFi because they're mainly used by institutions and professional traders, people who know what they're doing. And they use these kind of structured risk platforms, such as Barnbridge, of course, to obtain a fixed rate of return on a over a longer time horizon. And these, if you look at their platform itself, they're not going to be like super high APYs, which is why some people like institutions like them. If it's 10%, 15%, great. That's what they're after. They're not after the DeFi related, like 100%, 300%, 15,000% APYs per year. They leave the money for a long time. The platform itself, it's designed to give the investors, which are usually, as I said, institutions, an exposure to certain instruments that aren't really available in the rest of DeFi. So it's kind of cool. They have their place. I think that they're going to keep growing as more and more institutions come into DeFi or want like an exposure towards DeFi and get these solid 10 or 20% returns. But yeah, it's And these, I know Barnbridge, I've tried to use it before. It's kind of cool. It's not for me personally. It's a bit boring, but they do have levels of tranches as well for risk management and levels of exposure someone's comfortable with. But yeah, like Brian was saying earlier, this is completely different to insurance platforms like Nexus Mutual, Ensure, and of course, Steady State, which will be an insurance platform itself as well. So, but yeah, those are the two main categories. And sorry, I don't want to go on for too long here, but another big type of insurance cover or something which I would classify in this category is also like decentralized derivatives, which is derivatives based on price hedging. So OPYN or Open, I don't know how people say it, Hedgic, perhaps even DYDX kind of thing. And that's just using derivatives to manage price risk. That's not my thing really, because I don't know how to trade, but this is primarily seen in forms like things like futures, options, perpetual swaps. I don't know what kind of cool new products these guys have, but yeah, this is also mainly for professional traders, but also like a lot of retail investors get wrecked as well. Good, you trying to use derivatives. I would not recommend anyone do it. I personally have used it once or twice, and that's enough for me. Oh, and sorry, yeah, and maybe prediction markets, is that a type of insurance? I don't know. Would you guys classify Augur
I
and
think like one more maybe, which was of course like there is, I don't know if I could classify it, but essentially there's like traditional products. So you have like your flight insurances as well, but it wouldn't really necessarily cover what we have is like covering DeFi funds too.
Yeah, Brian and John, would you classify like Augur or something like prediction markets in type of DeFi insurance? Because you can essentially do similar things to price hedging, right?
I would call it hedging. Yeah, more than I would necessarily like insurance. Now, hedging is risk it can be classified as insurance, but often hedging insurance is often used when there's something totally out of control with massive movements like that's going to impact revenue or streams of income. And so what I would call that more hedging is more risk management, which it's self-insurance, like taking care of yourself and managing your own risk. So yeah. So like OPYN is a lot of hedging. Tranching is hedging. And hedging is often a tool used in derivatives markets or insurance markets to control your total exposure if you're looking to predict protection. I would say a great example of that is something called reinsurance. Reinsurance is a form of insurance that where when multiple insurance funds are having insurance pools protecting these different things. What reinsurance does is they get paid a portion. All these different insurers come together and they pay someone pooled risk, and the reinsurer offers to hold some kind of risk tolerance of each of the percent. But yeah, so that's hedging. So I guess it's a form of risk and insurance. And so betting markets are hedging more than necessarily insurance. It's like risk management, which counts.
Thanks, guys. So we see that we have many types of DeFi insurance models, but what are their benefits and what are their limitations?
Insurance naturally. Let's just take the normal broker insurance from Nexus Mutual. The limitations on those kinds of insurance is figuring out and validating what kind of event it is if someone owed a payout. And so that's kind of the major limitations of insurance is if the criteria is too broad, okay, the fund is going to get drained and the fund has to protect their interests. And if the criteria is too narrow, the protocol is not going to trust the fund because they're not going to get a payout. Those are like kind of the two main things dynamics you got to work out of, and that's probably the main risk of insurance is like is wrestling that. And there are multiple different kinds of insurance that come out to maybe control that or to alleviate the loss of the protocol, like a fund is willing to be more loose on what's being covered. One example is something called first loss policy. Usually in normal insurance, when you get health insurance, let's say, you're covered in the event of an accident or a medical emergency, and the costs are unknown. With first loss, you agree to a value. Like, say I get 90,000 covered and that's it. With parametric, you agree to the average rate of loss on an event. And if you agree to a payout pre to the event, you can often, with parametric, you establish criteria that can hit. And with with first loss, usually you still use indemnification. But often you can create the policies are a lot more looser because the protocol, the fund knows how much risk they're going to be expecting to tolerate, or a maximum amount, which helps them create broader policies so they can control that. That's kind of different risks you have with insurance, is not getting paid out, and the insurance fund is taking so much loss that they're not being able to pay out. Yeah. And so the two ways insurance combat not being able to pay out is they accept premiums. Okay. They take in premiums, they take premiums returns, but they do something else called flow returns. And what flow returns are when you agree to, say, getting $100 of coverage and you're paying a 5% premium on $100, $5 paid out. Okay. They take that $5 and they reinvest it and grow it. And they basically try to say they know on the premium they made in that fund is $5. On top of that $5, say they grow that $5 over the annual period by 10%. So it's $5.50. And the goal is to take that float money and constantly keep growing that. And as that keeps growing and expanding, the total fund size, the risk of not being able to pay out reduces dramatically over time. That's a whole very, I hope you guys probably a little long, but yeah.
No, not at all. Very interesting to listen, because to hear how it works in other models as well. Brian or Akash, do you want to add anything? No.
So essentially, like specifically I just want to, maybe I'll talk about Barnbridge a little bit. The advantages is, of course, it can have sophisticated DeFi products which expose to the DeFi sector, and they can have fixed yields, and they can have they can create some sort of like derivatives which aren't available in TradFi. There's complex instruments you guys can use people can use through those kind of risk platforms that aren't available for in other places, but it's also on the downside, it is very complicated for most users, which is, well, as I said before, it's more applicable for professional traders and institutions, and it can lead to unforeseen risks. And yeah, usually in those kind of platforms, the token holders don't really have many benefits. You'll usually check up with prices. It's more for like the institutions and rather than the retailers, and people don't really get excited about those kind of things. But yeah, like it's all these categories, like John did a good summary on Nexus Mutual and a couple other things, but everything's kind of differs. Like, it just depends on what type of products you offer, and who your target market is.
Yeah, you're on mute, Brian.
Just quickly to add on to what Akash said there, like, I was looking through some of the top insurance protocols by market cap today just to see how the movements are changing in the space, and like, it's very clear by the top 5 that they all kind of serve separate but slightly similar functions. And as Akash said, and as John also talked about, it is quite a complicated topic for most average users to come into the space and look at insurance products. It might not even be a very exciting category to some, but where the real, I guess, magic is done is where you can get coverage and everything happens more or less in the background, that you just buy into a product and you know that essentially this is going to do what it says without having to worry about how you're hedged or what, like institutional products that Akash just spoke about. So it's like funny to see when we look by market cap that after Nexus Mutual, you have like Barnbridge would be second and Insure DeFi would be third, both of which, the second and third, have completely different products. Whereas Insure DeFi is trying to put a very customer-centric buy X tokens and you will have coverage for all your products, NFTs for 3 months, which is a very simple to the customer. It seems very attractive, but again, I don't know enough about the back end, how it works, how they can essentially handle all the payouts, and if they are like 100% covered. Whereas when you deal with a more technical product like Barnbridge, you get this kind of surety that through the complexity that they have there and how everything is more or less balanced against each other, that the insurance market, what I'm getting to is, seems to be really segmenting into business and customer. And I'm sure where we're going to get to is where we're different. And that would be that we are protocol insurance, so that we would cover all users of a protocol as opposed to individuals. But yeah, just looking at like how the top 5 by market cap are structured out, it does seem that everyone has a little bit of their own universal USP, but all doing something slightly different. Like, for example, Armor, who would be the 4th biggest at the minute, they solved a problem in the market by basically reselling Nexus Mutual policies. And how they do it is that to be a member of Nexus Mutual or to get insurance, you must KYC. So essentially, they became a member of the mutual themselves, would buy insurance on behalf of non-KYC members. So when you think about a small innovation like that, they responded to a need in the market, and essentially they grew quite a lot of TVL through that, because essentially people wanted insurance. They didn't want to always KYC in the DeFi space. So Armor came in and basically solved that problem. And I think, you see that everyone kind of has their own unique purpose. And I think that's how there's space for everyone in the insurance space.
Thanks, Brian. So you mentioned already USP. So to our viewers who don't know, USP is unique selling point. But what is Steady State's unique selling point? What would you say?
I'll definitely hand this on off to John at some point. But when it comes to like Steady State, our very quick unique selling point is just the fact that we want to cover everyone in a simplistic manner. That if you are a member of XYZ protocol or you have XYZ token, and they say that they're insured by Steady State, that means that your funds are covered from smart contract exploits or any other sort of hack potentially that would be covered under the terms of their insurance. So it's essentially taking this away from the individual and making it more of a socialized insurance model that the protocols themselves would fund, potentially from the treasury. And it's more or less changing the way that insurance is delivered right now in terms of how it responds to the need and how essentially the cover is provided. We're more or less covering for potential problems without the user having to worry about them. I put it like that.
Yeah, so unique selling propositions, I would say, is there's going to be more to come out. And one thing I will say is governance tokens for a lot of these protocols often very much struggle. I think one reason, I can't speak as well for Insure, but for Bond and Nexus, I think one reason why their protocols are powerful is they have very strong tokenomics. And good tokenomics is very key for long-term players and getting long-term users in the system. So I think one thing I would say is our intention, and we're in a very, very deep redesign phase right now for some very interesting tokenomics. The second is what Brian said, is we're attacking a new market with business insurance. And we're already seeing market need and demand from clients already in that phase, where a lot of DAOs or fintechs with DeFi exposure do want to tell their communities, we have insurance and we're covered. And they believe that's a big bottleneck from mass adoption, and they want to be the ones to lead that cause and have their protocols be able to do that as well. I think one final third thing will be our approach to how we're building the insurance models. It's very unique. And has a lot of relationships with how Barnbridge or Saffron do their tranching, but its application is for a Nexus Mutual type coverage, and since and I think that's going to make a lot of fun for these users and how they go by building as this ecosystem builds out. But yeah, it's clear for Bond. It's clear games and it's clear systems and it's clear tokenomics. Same for Nexus. And a lot of these protocols that I think struggle is bad tokenomics. I think it's unclear use cases. And if you look at a lot of insurance protocols, they look almost identical to each other, in my opinion. You got to really be unique and different. The reason why Nexus is solid, in my opinion, is because they have first mover advantage. The reason why others that are a bit like Nexus Mutual, similar, may take over in certain aspects is because they're attacking a more niche industry, let's say like Solana, but it'll be the same concept. And I think one of the big needs is you need to be different, and a lot of these guys just aren't different. And and so I think that's kind of our long-term goals as well, is to be different.
Yeah, and just to add to John's points there, you'll see at some point the market will cool down a little bit. I know people don't really want to hear that, but we're not going to keep going at this parabolic rate as we have been going for the past 18 months or 12 months, whatever you want to consider it. And if you're a carbon copy or you're offering similar products to numerous other things in the market, like some of the insurance people are, you're not going to be able to survive long term. Well, that's my view anyway. Same in DeFi. Like if you're just going to be a yield aggregator or the similar kind of DEX or a random farm, but if you're just not really offering anything unique, you're not going to survive long term. Like short term, everyone might do well, everyone might do poorly. Who knows? It's kind of it's crypto, so anything can succeed short term. But long term, you need to be different. You need to have a unique way of selling your products, a unique offering in the market, and most importantly, you need to also be able to have a solid revenue model as well as a token utility model, which is something I'm sure John and the team are going to release very soon as well. So it's all these things combined. If someone is looking for longevity, then the unique selling point is super, super important.
Thanks, guys. And as I understand, Steady State aims to be different and stand out. And our viewer, Trading Knowledge, actually asks, I'm going to take this here in between, how different exactly?
Yeah, so one thing I'll say right off the beat is how insurance normally works, okay, is a lot of people aggregate money for a pool to cover an event. Okay, so let's say how it works on Nexus Mutual is they offer coverage for certain different kinds of hacks or events on a protocol, like Cream Finance, the hack that just happened this morning, this evening, wherever you stand. What I would add is if you did that same kind of model, okay, we're just going to cover Black Hat exploits for all protocols on the same kind of model like you would do in a normal insurance fund, and it's going to be really tough to pick and choose people to bring in that model because there's a lot of chance for bad activity or people trying to hack themselves. What we're looking to do is get insurance for events on the protocol. And so what that means is rather than having one pool covering all these risks and protocols can opt in to get a policy, okay, it's going to be covering a bunch of risks on one singular protocol or one risk on a singular protocol. And so what that will probably do is then if I want to stake money, I'm now betting on the likelihood of an event happening on that protocol rather than into a pool. You take the hack on Cream Finance today, that could drain a whole Nexus Mutual pool dramatically. It would destroy it. And we know that. And so we're looking to build a different kind of model where if you had one pool made up of a bunch of getting protocols getting insurance, one protocol filing could destroy the whole pool. And so rather than that, you got to insure the individual protocol. And that means only that one individual pool will get distributed directly for the protocol. Then what we do, though, is we're all DeFi users. We don't want to get wrecked. No one wants to get wrecked. If you use the protocol, you're going to get wrecked. If you get into this one individual coverage pool, you're going to get wrecked. That's the point of the index pools. Okay, no other model has this in insurance. This is more Barnbridge, Saffron Finance stuff. And like I said, we're a derivative product doing normal insurance risk. Whereas index pools are pools with way exposure to multiple pools. And so you're in a pool with 5% exposure, let's say again to 20 protocols, you put $100 in that fund, then you're exposed at 5% weight loss potential to those 20 protocols. So because of that, your downside is much more controlled and your upside is actually could be much more expansive. where you're getting exposure to a bunch of protocols. I don't know about you. I have a hard time picking up winners, especially in the DeFi market, in the altcoin market, and it's going to get worse during the bear market. If I know I have a lot of tried and true protocols that are going to win and survive the bear market, and I'd rather than try to pick which one's going to 100 or 10x, I can just accumulate all of them. I'm going to do it myself, and I think that's good, smart finance, is good risk management, and I think that's something we're all going to love. Granted, again, we may not attract all the degens because it may be barn and bridge a little boring, but that's where the tokenomics and the difference in tokenomics comes in. I think what we got to do is to start creating a clear pathway about why you want to use our ecosystem and not just contribute. Okay, why do you want to be part of our ecosystem in the long term? And that's where good tokenomics comes in, where if you have a solid token that offers multiple different value adds to access different outputs that you want to contribute to the community, and you can receive different revenue streams or value from, that is what's going to bring you in long term. So these coverage expos can be cool and great, but it's immediately that's not going to work, right? And so like it could work, it could not work. It matters how long you actually want to be here. If people want to contribute, that's where the good tokenomics comes in and makes us more different. Is being able to get into a fund, receive tokens for contributing, be able to stake those tokens, receive tokens, and eventually those tokens are used to actually receive a new level of value. And we'll be announcing that more soon. But the goal is to create a clear pipeline for you to grow and build out in this ecosystem. And that's something that's going to make us really different and hopefully separate us from the market. Not to mention that we're business insurance. That's just very unique right now still in the industry. It's still untapped. We have clients and we're still growing and building. And I'm excited to see how that market builds out too. If you really think about it, a lot of the industry, we're insuring our risk to our exposure to every protocol we use. Why can't the protocol just get insurance? We're going to be asking that question. Why can't Cream Finance just get insurance? And we're going to be asking that problem today. And if you tell me Cream Finance is insured, it's going to bring a lot more peace of mind to a lot of users. A lot of people are scared of hacks. A lot of people are scared of exploits. Being able to say they're protected from that is a powerful narrative and is going to help them push DeFi to the next level.
Very good. Love that explanation. But let's check out. We have some more. Trading Knowledge wants to know that when do you reveal the dates on tokenomics?
Well, we released like a B1 doc. I'm not sure if it's public yet, but I'm doing presentations right now on what I want to be designed like. And hopefully after they'll get approved by everyone, I hope to get that out. But that's also going to be very, very exciting on that as well. But I'm hoping soon. But I'm not sure if the new kind of structure and ideas where we're trending towards is public yet.
Thank you. So let's check out EJ Vanderdenberg asks, how could steady state play a role in NFTs projects, if at all possible?
So NFT projects are really ramping up to be something interesting, and I know where I don't think it's going to take time for us to understand what these NFT projects are going to look like, but once we understand what they look like and the different kind of risks associated with that, we can probably make a play for NFT insurance. But it's very confusing right now how you can do that. Are you insuring community? Are you insuring NFT? Do you insure the object of the NFT? Do you insure the value? Are you insuring the bonuses or the royalties or utilities that come from using NFT? That's still very, we haven't seen these communities built out yet, so it's really tough to figure out how you do that. A blanket, say, loss of insuring the stop loss of value is very dangerous, right? Someone can dunk the floor and still get rid of their ETH, arbitrage, and get profit off that. That becomes a very dangerous play of insuring. So insuring the object, that requires a lot of creativity on how you insure the object. I think it's a tethering model would be one to solve that. But then if you tether the token to NFT to a token that can move the NFT around, then you create centralization risk potentially, and that's another thing to consider. It's still an untapped market, so it's really tough to figure out what risks to cover. We still don't know what risks are important to users and what risk are they actually exposed to. We have an idea, but we don't know because we haven't been in this system yet.
But it's in their game plan to at one point get there.
Yes.
Mm-hmm. Awesome. But lastly, I would ask, well, we kind of sort of talked about it already, but maybe want to add anything in the end. Where does steady state excel compared to competitors?
What was the question again?
Where does steady state excel compared to competitors?
I think it's going to be two things. I think it's going to be the yield model. I think what's going to turn to is the yield model, and hopefully, if we nail it right, it'll be the tokenomics. And I think those will be the two things that are going to be really attractive. I think a lot of protocol, a lot of funds. We're still doing a little bit of pricing models, but a lot of funds and insurance funds keep trying to promise high payouts for staking your risk to cover the protocols, but the payouts are always in stable coins. And so if you can't really get a high payout in stable coins, it's just protocols aren't going to pay that out. And it's also, and if you're are going to get them to pay it out, it's going to be really hard to get enough coverage right now in the industry to do that. I think paying in governance native tokens is going to allow a much higher premium. The index pool model also, it's going to allow really fund diversification that you're not necessarily exposed to in any kind of insurance fund model. And I think the coverage index pool is going to be really powerful, but also it's the tokenomics. Tokenomics, Nexus Mutual is powerful because it's community. The community can be powerful because of the token, in my opinion. And tokens are legitimate stakes in a network, and they need to be treated as such. And so I think it's really important to have those two things. And I'm hoping that's where we're going to excel from the competitors, is really well thought out, really drawn out long-term tokenomics. And the other aspect will be the coverage index pools. And I think between that, we can start evolving from there. And we have ideas we want to use to evolve from there. But I think those are two very key aspects to build from. And I think those are going to be two kind of frameworks we expand out of. And we have some other ideas I'm starting to float and starting to move on. They'll take time, have to take in legal risk and considerations and all that other stuff. But those are, I'd say, the two big things where we excel compared to competitors is that, yeah, I hope we're going to sell.
Thanks, John. And we also have one question here for Akash. How did Aussie lawyer find his way into steady state?
It's a bit random, but I was working. I mean, I've been involved in crypto since the previous bull run, so 2017, 2018. And it was just more interesting than my previous job as in the Attorney General's office. So I started getting more and more involved during the bear market, 2018, 2019. Started investing in pre-sale funds and investments. From there on, we kind of freelance for Yield Up a little bit, and then through Tim Frost, I met John Libby, who was fronting up his own insurance product, steady state insurance project. And yeah, just got involved, quit my job, dived in. And it's been fantastic so far. Great learning experience. It's one of those things where sometimes the industry just clicks. I had a great time being a lawyer for the past 5 or 6 years, but this is way more exciting than working behind a desk or doing a 9-to-5 job kind of thing. And this industry, I think, if anyone out there who's thinking about diving in to full-time crypto work, this is a great time to do it. I think your career, and we'll thank you a few years later down the line, because this is the industry where it needs everyone. It doesn't matter if you're a dev, it doesn't matter if you're a marketer, it doesn't matter if you're a lawyer. It needs people. It needs talented people who can come in and get really involved. I think we discuss this pretty often in our team, because when we do recruitment, there's such a lack of talent available because everyone's desperate for to get more and more people in. So, hey, if you're a corporate lawyer, or I was a child protection lawyer previously, but any type of lawyer who wants to come in, we need people who work in risk and compliance. We need people to work in drafting contracts in this industry. So it's a great opportunity out there, and it's kind of like I think it's probably I wasn't involved in the previous the .com bubble, the run, or the bubble, or the tech industry growing up, because I was too young. But I'm imagining it was kind of similar, because if you choose to come into the industry at an early stage, which is where we're at right now, it's very profitable. You can build your own networks. There's a lot of upside here, and it doesn't have to be as a coder or a developer. That's what most people on the outside might think, but there's just like any company or any sort of industry, there's a lot of we need people from all sorts of professions involved.
Thanks for sharing this, Akash. And I definitely agree with this saying that coming into crypto space, no matter what you do, definitely changes your career and your path. So come everyone. Okay. But also, last question for Brian. How did Brian got involved? Share us your raw thoughts. Also share us your raw thoughts on something associated with today's topic.
Probably wishing I had insurance about 7 years ago when I got wrecked on a lot of Bitcoin and stuff. No, I guess actually I'll make it very quick, but I got interested in crypto, quite a few years ago, like 7 or 8. I had free electricity and I was a hungry college student wanting to figure out how to make some things work. And background in computer science, I've always been interested in new technology. I'm a little bit older than Akash, and that I actually do remember the dot-com bust. I graduated, or at least started a computer science course the year of the bust when I was 17. So it tells you a little bit about how old I am too. Oops. But the thing is that like it's always in the bear markets, and right now the bull market, which is quite exciting. But like what stood me well was I got into IT and web development just around the time that people said it wasn't going to happen and there was a big bust. But the fact is things were built then, the strong projects survived. And I think whether there's going to be a bull market or a bear market for the next year, that's how it's going to be anyway. And I kind of stayed in the space, worked with various different companies in the peer-to-peer model, which kind of set me up to sort of understanding, okay, how insurance can relate to individual issues and so on. But anyway, to make a long story short, got into DeFi last summer, started reading about some projects. I had been working in the Bitcoin space for about 3 years in a product marketing role. And like Akash, I was like, okay, Bitcoin is really interesting, but it's like gold. It's just a brick that does nothing. And it's like security. It's great for, the system, but ultimately, it's not very exciting, and the exciting projects are more or less being built out in DeFi and the DeFi 2.0 ecosystem right now. So when I started hearing about plans for steady state and basically how they want to take this like better capital efficiency, solve a lot of the problems that are there in the current insurer space, the talking points just spoke to me and said like, okay, this is needed. It's going to be, insurance is going to be a product that's going to be wanted year round, whether you're the person looking to earn yield or you're the person looking to get cover. And the big problem with insurance that I seen and what got me into especially DeFi was that insurance is a really great stable product for anyone to invest in and earn yield. The problem in DeFi is you can just go to Aave and potentially earn a lot more. It could be a bit more risk, but the problem with insurance right now is that it has been quite low yield, low fun, not very exciting. But with these new capital efficiency models that we'll be bringing in, it's going to mean that we'll be getting comparable yield for investors and stakers. Those who want to stake would be getting similar to what would be other savings protocols right now. So I think this should open up insurance in DeFi. And I think I kind of got off the point, but that's why I'm here. Got very excited by the space.
That's great to hear. Thank you, Brian, for sharing this with us. And I see that we don't have more questions. So that means that we can say many thanks to our speakers, Jonathan, Akash, and Brian. Thank you for this great discussion. And thank you all for tuning in. Before you go, we remind you to take part in Steady State's Ambassador Program. Up to 200,000 Steady tokens will get distributed. And yes, from now on, it is a Steady token instead of risk. So keep that in mind. And that's it. See you guys next week. Take care.
Thanks, Sylvia. Thanks, everyone.
Thanks, guys. Bye.